The big news this past week on the economic front and the market front was the jobs report. The jobs report came in very favorable, and I will explain. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is June 11, 2024. The jobs report showed that 272,000 jobs were added in the U.S. economy. The consensus was that 190,000 would be added, so this is outperforming the expectations by about 80,000 jobs. The previous month was 165,000, so things were definitely on the uptick. However, it seems contradictory, but it's not necessarily. Unemployment rose to 4% from 3.4, so a 0.6% doesn't sound like a lot, but it's a lot. Unemployment went up to 4%, the highest since January of 2022. Job gains were concentrated in healthcare, government, and leisure and hospitality. The average hourly earnings were higher than expected as well, rising 0.4% on the month over month, and 4.1 year over year. This is a chart showing the last couple of years of monthly job creations. So you can see to the far right the amount of jobs that were added relative to the previous months. I'm going to play a couple of clips that will break this down and explain it. The first is from Rick Santelli, and he's responding kind of as the report is coming out. He's reading his notes, and it's live, okay? So, and he goes through a lot of the components of the jobs report, and I think it's interesting. And then I'll show two more after this one. So take a listen to Rick Santelli.
Rick Santelli is standing by at the CME in Chicago. And Rick, take it away.
Yes, it's the big jobs report. The change in non-farm payrolls, stronger than expected, 272,000. 272,000. And if we look at revisions over the last couple of months, we lose 15,000. Now, let's go through it all, shall we? If we look at the unemployment rate, for the first time since January of 22, it hit 4%. Yes, 4%. And if we look at month-over-month earnings, well, month-over-month is stronger than expected, up 0.4%. Why is that important? Because that is the juiciest increase since the beginning of the year when it was up 0.5%, and the 0.5% was the highest since March of 22. So we're moving back up a bit. Now, if we go from month-over-month to year-over-year, also stronger than expected. 4.1%. That equals March. To find a higher number, you go to February when it was 4.3. We started out the year at 4.4. If we look at the average weekly hours, 34.3, exactly as expected, exactly like the rearview mirror. Labor force participation rate actually moving down. 62.5. The recent high watermark was 62.7. That was last month, and that was the best going back to November of last year. But this number at 62.5 equals February. To find a lower number, you have to go all the way back to January of last year. And finally, what we call U6, or the underemployment rate, versus U3, which is the one we talk about, which just popped to 4%. This one remained at 7.4%, where it was last month. But that is the highest level since November of 21. We could see interest rates went up, and for good reason. Stronger jobs, definitely stronger on the hours. The unemployment rate, though, moving higher, I would have thought potentially would have been strong, but it doesn't seem to be able to push back the tidal wave of what wages seem to be doing in job creation.
Next, Joe Kernan interviews Roger Ferguson, who is the former vice chair of the Fed and asked him his opinion on it. And he sees a likelihood of a rate cut later this year. No one is willing to say a rate cut in the current environment. And Roger Ferguson explains why. Take a listen.
Let's get more reaction to the jobs report. Joining us now, Roger Ferguson, former Fed vice chairman, as well as a CNBC contributor. But the last thing I was saying, Roger, was I asked for where Fed futures were, and I guess that July went to like 8%, but still like 50 and 60 before the end of the year likelihood. So there's still, I mean, I don't know, we're still on track for cuts. And it's confounding to me. You're always nice, as I said to your former colleagues, but does it make sense to cut in 2024?
Based on the data I've seen thus far, I'd say probably not. More data to come, obviously, but to get to particularly the December meeting. But look, the jobs report this morning showed the economy is in good shape, creating more jobs than expected. Some of the disinflationary pressures that had come from the supply chain seem to be behind us. So I think it's definitely a wait and see moment. And I wouldn't signal too much eagerness to cut because I'm not sure the numbers are going to allow that in the near future.
All the same questions we always ask ourselves, Roger. Do you have a high degree of confidence that where the Fed is right now is slowing the economy and is restrictive?
I don't have a high degree of confidence. It is clearly somewhat restrictive. I've been surprised at how much resilience the economy has shown, given how aggressive the Fed has been. And so without getting too technical, there are debates among policymakers as exactly, how restrictive are we? What is this elusive thing called R star, the neutral rate? So I think the data is suggesting them certainly stay put where they are. Talk of cuts premature. A few have suggested a possibility of a hike. That doesn't seem likely right now, but I wouldn't say it's impossible as we get towards the end of the year.
And then a third perspective. This is from Stephanie Pomboy. And I thought this was really interesting because she dug into the data and she saw, and she's an outsider. She's not Rick Santelli, who works for CNBC, or Roger Ferguson, former Fed vice chair. She is an independent researcher selling her research to Wall Street. So she had time to dig into it and found that there were actually some negatives in the report. It looks like on the surface it sounds all positive, but she looked at it from the perspective, and this was in the report, from the perspective of households, not just individuals. So when you look at from the standpoint of households, there were actually a decline of 408,000 jobs when measured by household. Wow, that's significant. And the unemployment increased 250,000 jobs, also significant. So this headline of the fact that jobs were added, that could be new jobs, it could be people entering the workforce, it's a variety of factors. But it's interesting, her perspective was to look at it a little differently and basically say that the unemployment is not favorable. She goes on to say, and this again is another insight I thought was something that's not on the surface, that when unemployment went up from 3.4% up to 4%, okay? 0.6%. And you may think, who cares? Not a big number. But she says, whenever unemployment goes up at least 0.5% in a month, what follows, what has always followed, is unemployment rising 3%. In other words, 300 basis points. So she sees, based on history, that if that pattern continues, that we are headed to a much higher unemployment number, namely around 7%. So take a listen to Stephanie Pomboy.
But here's the point. Household employment declined 408,000 in this report.
Wow.
The labor force also declined 250,000. That gives you the 4% print on the unemployment rate. This is the story, Maria, it's a tale of two cities here in terms of these employment numbers, whether you're looking at payrolls or households. And historically, the household survey has been a much more reliable measure at turning points in the economy, because what gets the payroll number off track is this birth-death imputation that they make for new business formations that tends to miss turns in the economy because it's based on last year's business formation data, not anything current. So I would focus on this, the household survey, which shows substantial weakness on the employment front, again, down 408,000 in the month. And I think that's really the story. And I would go on to point out that the unemployment rate has now increased 0.6 percentage points. It sounds like nothing, from 3.4 to 4.0, still very low. But historically, when you rise half a percentage point, you then go on to rise 3 full percentage points from there. So not to get too deep in the weeds, but that means we're looking at a 7% unemployment rate before all is said and done here.
And then I wanted to play a piece from Liz Ann Saunders. She's interviewed by Carl Quintanilla, and she gives a good recap on the year-to-date performance of equities. Take a listen.
Let's talk more about where the market goes from here this morning. Charles Schwab, Chief Investment Strategist Liz Ann Saunders is with us. Liz Ann, good to see you.
Hi, Carl. Nice to see you, too.
You know, there was some chatter when we crossed the 100th trading day of the year that when you get to that level and you're up 10% year to date, the year ends up historically being pretty good. Is that a reliable thing to count on?
I think none of those anecdotes are reliable on an every year basis. We also have to remember that you can look at those trends at the index level, but what's really noticeable this year is what's going on under the surface. You know, in the case of the S&P 500, it's not as extreme, but you've had no more than, I think, a 7% drawdown at the index level, but the average member has had a drawdown of 14%. That average member drawdown goes up to negative 35% in the case of the NASDAQ. So I think the real story of what's going on is not necessarily being told at the index level because of that bias up the cap spectrum, the Fab 4 contribution, as you said. There's so much churn and rotation going on under the surface. I think that is telling the more accurate story of the relationship between the market and all of these macro uncertainties.
Right. Now, the question for a lot of desks this week is whether or not these drawdowns are calling into question the fundamental case of at or above trend GDP growth, positive EPS growth, and a paused Fed. Are you seeing those things getting called into question?
I think the sort of parlor game that's going on still with regard to the Fed and when will the first cut be, how many cuts this year, and that changes, of course, with every data point. But I think more important to the equity market broadly, but also specific to factor leadership, whether it's small caps getting a lift or getting hurt disproportionately, is yields. I think the bond market is really in the driver's seat for the equity market right now. Now, of course, there's a relationship between moves in yields and prospects for Fed policy. Those are connected, but it's that real direct inverse relationship between bond yields and equities, with the inverse relationship being much stronger as you go down the cap spectrum, because obviously there's greater interest rate sensitivity when you get into the smaller companies. And that's, I think, really where the leadership has been defined is based on what's happening in the bond market. And for the equity market, it's very specifically the 10-year yield.
Okay, thank you for listening. If you have questions or comments, leave them in the comments section below. This says, he's like the 10-year Treasury. He's very sensitive. Pretty good cartoon. Okay, thank you for watching.